Good morning, all, and thank you for attending the new edition of the new Central Bank Watch. So I give the floor to Carlos and for the added value now. Carlos, it's up to you. You can start with the new highlights after the recent central banks meetings and your comments on the next actions on the different asset classes. Thank you.
Okay, thank you, Francois. Thank you very much, and welcome everybody to this webinar on December the 18th. It's been a very busy week last week regarding central banks, and in fact, it's been a tremendous 6 weeks since the November the 1st FOMC meeting. Markets have been discounting a lot of things. Global macro has been moving a lot. Portfolio allocation has been rejigging portfolios in a very aggressive way. And 2024 outlooks look slightly different than 6 weeks ago. So a lot has happened over the past 6 weeks. And we have a very clear idea about what has happened and what is likely to take place in the next few months. Because if you recall, on October the 27th, we published with Francois and Altiplano, we published a note which was the core of our macro view regarding macro timing, highlighting the all-important unemployment rate rule that we have developed at ImagineAlpha. That unemployment rate rule was saying that should unemployment rate in the US print 3.9, everything would be changing, and that's what happened in early November. On November the 3rd, the non-farm payrolls came out, and the unemployment rate was rose to 3.9%. And what happened afterward was a massive reallocation of capital in favor of all kinds of risk, but especially boosted by the decline of interest rates across the curve. That has eased financial conditions tremendously over the period, and has led to a lot of soul searching regarding the outlook for 2024. So without further ado, we are going to go into our presentation, which is the rule of engagement is that this presentation is a preparation for the next central bank round of meetings that will take place at the end of January. And for the FOMC, it will be January the 31st. So we have 6 weeks. We have 6 weeks to prepare the next FOMC meeting. And during these 6 weeks, we are going to try to anticipate as best as we can what the markets are telling us, what the officials are telling us, and what kind of scenarios are most likely to take place. So what is important to notice to emphasize is that at this very last meeting, we saw within the G4, we saw 2 sets of behavior and 2 sets of comments. We saw central banks like the ECB, the BOE, saying that nothing really changed in their posture and in their guidance, although some downside risks have been recognized. Nothing has changed in terms of the cycle of interest rates, and especially the discussion about rate cuts going forward. That debate was sparked by comments at the presser of the FOMC last week when Chairman Powell decided to acknowledge that some discussion around rate cuts had taken place during the FOMC in December. So this disconnect between both groups of central banks has sparked a lot of interest in the market and needed some clarification. Now, if we dig into the data that was presented at the FOMC, we see that in fact everything is much conditioned on one single thing, which is the persistence of the soft landing scenario on which the Federal Reserve has been banking for the last few months. And chief among indicators in that soft landing scenario, we would focus on 4.1 as the unemployment rate as being the core or the most important gauge. Yes, we are not focusing much on inflation. We will discuss about inflation in this webinar, but we want to emphasize that the pivotal gauge for the next few weeks and the next few months is, on our opinion, the behavior of the unemployment rate. In fact, in a stealth manner, the second leg of the mandate is slowly taking over the first leg, which is inflation fighting. So after the FOMC, the market and the ECB and the BOE meetings, as a matter of fact, but the market has decided to continue on the dovish narrative. Clearly, the market has been voting dovishly, but the Fed, in fact, has been fairly prudent if one considers the entirety of its communication. It has not fully endorsed the market willingness to be very, very, very dovish. So now we are faced with two narratives that are in the balance. The markets are leaning hard landing, in fact, because the justification of 150 basis points of rate cuts very, very rapidly, starting in March, is an endorsement of a hard landing scenario of sorts. Now, we will see that the historical perspective is giving some probability, but still a reduced level of probability, but some probability to that scenario, the scenario that the market is now endorsing. And the Fed is really favoring a soft landing scenario going into 2024, and it transpires into the summary of economic projections. As we said, or as I said earlier, the 4.1% unemployment rate is the key determinant, the level, the gauge that will decide when the Fed will shift as a game changer indicator, will shift its behavior from the soft landing towards a less benign scenario with a sharp acceleration of the increase of probabilities towards a hard landing. But as long as 4.1, as long as the unemployment rate is below 4.1, the Fed is communicating the way someone who has few constraints on its attitudes. So we will see why 4.1 is so important and how the markets can react. But if you want to keep a summary of the view, is that below 4.1%, which is in fact converted to payrolls like statistics, is non-farm payrolls between 130 and 200,000 on a monthly basis. The soft landing scenario will prevail. below 130,000 non-farm payrolls, the harder landing scenario starts to take over, and therefore the behavior of the central bank will be adjusted more aggressively. Now, because the market has decided to go for a more aggressive posture, it is pricing the hard landing immediately, and we see the immediately as in a strong probability of the beginning of the hard landing in the first quarter, with a probability of a move, which is the chart on the right, a not marginal probability of a move at 67% for the March meeting on March 20th. Now, in order to get to that, in order to deliver on that probability, a few things will have to take place. But we see that over 1 month, the move in terms of probabilities has considerably increased. A month ago, almost to the day, the probabilities of a rate cut in March were about 30%, and now they they were about 31%, and now they have doubled. Now, so there are 3 essential reasons why we think that the coming few weeks are particularly interesting, and why the market is giving us a more than dovish, more than a reasonably dovish posture. In fact, it revolves, and that's the first reason, around the signaling of the dot. Before the FOMC, the focus on the debate around the dot for 2024 was will it or will it not add a rate cuts into the projections. It did, but as a matter of fact, it's not really as dovish or as revolutionary for the FOMC to have a dot that is at that level. If you look at the chart on the right, you will see that in orange, the line in orange is the year 1 dot, year plus 1 dot. This year plus 1 dot is in fact validating what the market was telling us from a OIS or from a 2-year yield standpoint at the time of the FOMC. It's just that the fact, history has shown, recent history has shown that, in fact, when the Fed follows market anticipations, really, there is nothing much in terms of volatility to expect. Now, in this instance, the market has taken that as a signal. Now, we will caution against that, because if you take a look at where the year plus 1 dot is, it is above where it stood in March, earlier in March 2023, when there were risks of a hard landing due to the stress in the banking sector in the US. Now, that dot in year plus 1 is above that level from March, so a level of risk aversion, a strong risk aversion, and it is right about where it was in June, when around the last meeting before the end of the hiking cycle. So taking an interpretation of the movement of the dot as being a dovish guidance is, according to our view, is just it's just wrong. It's just that the dot is moving with the market prior to the meeting. The market has just decided to amplify that decline by adding on some more rate cuts. Now, the second reason to be quite cautious on the ultra dovish scenario that the market is running with is coming from the inflation front. We know that the path now from the SEP, the projections that we got last week, that by and large the landing of inflation, according to the FOMC, will take the shape of the black line on these two charts. The right-hand chart is showing you that by about April, May, a level of around 240, 250 will be reached, around 240, and it will be fairly difficult to get below 2.4 in core PCE from May onward. Now, this, of course, is subject to changes, but it's important to note because for the market to validate, for the FOMC to validate the market scenario of a rate cut in March at the March 20th meeting, something will have to snap in the data between now and sometime in February. Okay, and that something is not necessarily inflation, because the path is pretty assured to be that one. It's something along the macro data, and the macro data, apart from inflation, is essentially the payrolls. Now, this is the transition to the third argument, which is containing our enthusiasm towards the dovish, the ultra dovish interpretation of the monetary policy stance at the Fed, and that is that if you look at the table on the left, is that although the inflation has a downward path towards the target, we have an employment rate that stays static across the period. Now, this is a forecast. This is by all means, this is a forecast that is likely to be negated, but it is interesting because it's framing the debate around what's behind the thinking of the policymakers. And in fact, it's reinforcing the importance of 4.1 as being the level of reference where the behavior, underneath of which is the behavior that we know, which is a fairly prudent, but somehow accompanying the movement of the market, and above, which is in fact taking the lead into a different setup, policy setting, meaning more aggressive stance towards the dovish side. So the market at this point is running ahead of the 4.1% and is behaving just like the 4.1% unemployment rate will be reached fairly soon and will be breached fairly soon. Now, we don't think that there is anything wrong with having a strong conviction around discontinuation of behavior, abrupt changes of behavior around certain levels of certain thresholds of unemployment. We have our own, at ImagineAlpha, we have our own unemployment rate rule. It just happens that it's 3.9. And in the previous webinar, we showed that within 3 to 6 months of that rule being triggered, a certain amount of discontinuities were taking place in the economy, chiefly on the labor market, and we highlighted that the unemployment rate and the duration of unemployment was increasing with it. Now, in order to have a objective understanding of what is what is the intention of the policymaker. We have to take what they tell us, and they are telling us that the unemployment rate rule of ImagineAlpha is something, but they're especially telling us that their level is quite different. And it's also different from the SUM rule, which is also another unemployment rate rule that is out there and has been used and is quite useful. So if 4.1% is the alpha and the omega of handicapping the behavior of the FOMC, because it's abnormally stable across the forecast period. We have to understand what's going on around 4.1, and it just happens that 4.1 or 4.2 is a level that is also that also transpires in other ways of looking at the economy and the labor market. We have on the chart on the right the unemployment rate in white. It's been inverted, and you will see in the next slide why. But it's the unemployment rate in white, and the yellow line is the 36 months moving average of the unemployment rate. And it just happens that that line, the 3-year average, which takes the whole pandemic period and exit from and the early post-pandemic period. So it's really the right gauge of what is equilibrium in the unemployment in the labor market. That line just happens to be 4.2. Very interesting coincidence. Now, it is a coincidence. It could be a coincidence, but it just happens that it reinforces the message that 4.1 is important. 4.1, or we would say 4.2. And here is the reason. So here we've got 50 years of the unemployment rate in white, and we see that when the white line crosses below the yellow line, it's usually also signaling the NBER dating of the beginning of recessions. Okay, it's just happened every time. Now, there is little doubt that that the U.S. economy is in late cycle stage, and that at some point this will happen. And the blue line is the Fed funds line. So the Fed funds tend to move ahead of the crossing of the 3-year moving average of the unemployment rate. So what it means is that for as long as the unemployment rate stays under 4.1 or 4.2, the Fed has got room to maneuver to adjust at the margin its interest rate. 75 basis points just happens to be very close to the average of the pre-recession moves that took place in the past. So for the last 7 cycles or so, we see that in 19, at the time of the pivot, and we will talk a lot about the pivot in 2019, the Fed did 2 moves ahead of the recession of 2020. In 2007, the Fed did also 2 moves worth 75 basis points. In January 2001, the Fed did just 1 move. And in 89, it did a few more moves, and it was a slide into the recession that took a lot more time for reasons that were very peculiar to that period when the economy was overheating because of extreme dynamism of the credit space. In any case, what it means is that at this moment, we can expect the Fed to try to adjust before 4.1 is pierced, but it will just be at the margin. The large adjustment will come if 4.1 or 4.2 breaks. Yes, Francois?
Yes, Carlos, I've got a question on the unemployment rate. The first one is, what are the upside risk on the unemployment rate? Because from an historical perspective, this 4.1, 4.2 remains very, very low. And the other question, the underlying question, back to the previous slide, is over the next 3 years, 24, 25, 26, we see that the unemployment rate is going to remain pretty stable, with interest rates moving down, inflation moving down, converging to 2%. So in other words, this is a kind of blue sky scenario of perfectly well managing everything to have this kind of stable unemployment rate, inflation moving to 2%. So everything looks very perfect in the table. And what I would like to understand is what are the upside risks in terms of unemployment rate, and what are the risks that the sequence in cutting rates just need to be amplified because of underestimating what has been done so far in terms of tightening the economy.
Yeah.
So that's very important, because at the moment the market has not reversed the yield curve from inverted to a kind of more bearish steepening. And what are the implications, potential implications of all these structure in the yield curve and the risk on risk of trade we can have? Because if we go too far in terms of tightening the economy, the unemployment rate going too high, the bad news, which is good news today, could be converted into bad news is bad news. This is my point.
Exactly. That's a very good point. That's exactly where we stand now. That's the disconnect between the market view and the Fed somewhat more contained dovishness, very much contained dovishness. In fact, as long as 4.1, 4.2, as long as the dynamic of the unemployment rate does not accelerate. So we have it at 3.9, they have it at 4.1 or 4.2 on this slide from the moving average. It's about the same thing. We're looking for this discontinuity in the data set at some point. Now, ahead of that event, the soft landing scenario is the prevailing scenario, or has to be the prevailing scenario, because we will see in the following slides the employment market is perfectly at equilibrium. It's a great achievement of having the labor market so at equilibrium. But being in a position of seeing inflation receding slowly, whilst the labor market is responding, is normalizing, and there is no shock or hit to confidence, despite the high level of restriction in the policy rates, is quite remarkable, and it's what the markets have been affirming during the month of November, with the large risk rally that we have witnessed. Now, the bad news is good news, or the soft data is good news, will end if and when 4.2 breaks, and bad news will become bad news at that time, indeed. Now, in order for that to take place, 4.1 or 4.2 to break, we take historical precedents. Something needs to happen to hit confidence. The supply side of the economy needs to be hit by a confidence shock, and that is just like the black swans, it's hard to time, and it's hard to define precisely what it is. It could be coming from the financial sector, even though the main banks are well capitalized. We've seen with regional and second-tier banks that it was not the case. So it could be the return of some tension there. It could be coming from the credit space with the funding or the rollover of debt in the high yields space. It could be coming from an external a shock, or it could be coming from a no landing or a reacceleration of inflation for some reason that are not expected at this time. But it could be that inflation or the reacceleration of inflation could be one of them. Now, it's hard to forecast, but it's not so difficult to observe that when what history is telling us, that when the 3 months, the 3-year moving average of unemployment is pierced, something is happening in the real economy, and the bad news become then really bad news. Here on the left, it's a chart from our previous webinar, but I just want to highlight it because it's our own definition of the alert line. It triggered at 3.9, and the quality of the signals is very, very good. So one could argue that when 3.9 prints, usually 4.1 or 4.2 will print. And we are in this in-between situation, this in-between period where it's a twilight zone of risk, twilight zone of risk appetite or risk-seeking behavior, because the bad news has not turned into bad news. But yes, at some point, it might well be the case. And that's when, going back to the SEP, that's when on the left-hand table, that's when everything will change in the committee, in the behavior, and in the decisions related to forward guidance and monetary policy. So at that time, when 4.1 prints or 4.2 prints, the last line, which is the projections for interest rates, the dots, will migrate meaningfully lower. To which level? Well, 2.5, because as you can see, 2.5 is the longer run target, the long-term dot. Okay, and as you know, we have been proponents of this new rule related to the nominal Fed funds rate, which is the L-star rule, which takes the dynamism of the employment of the labor market and of demography and use that as the central statistic in forming the equilibrium Fed funds rate. And and our research has come up with 2.5 as being the right the neutral rate, somewhere around between 2 and 2.5. Slowly trending lower towards the end of the 2020s into the early 2030s, down to 1.75. So for us, there is no surprise there when the behavior changes, when the time comes for the slowdown in the economy to be meaningfully visible on the unemployment rate, then monetary policy will start to migrate towards the neutral rate and below. It will be gradual, but we are encouraged that the dot has not been meaningfully changed, which is supporting our view that our star has not moved. And President Williams from the New York Fed has been arguing so for the last few months. So we are in this in-between period between the breach of our unemployment rate rule and a putative breach of the Fed's unemployment rate threshold. Now, this is a Goldilocks with inverted commas sequence, and it is best highlighted by these two charts. The blue line is showing us the balance of the labor market. We're taking the supply of the labor market, the growth of the labor force, and we're taking the demand in the labor market, which is the employment growth from the household survey, that's the chart on the left, and from the establishment survey, that's the chart on the right. And you can see that both blue lines are close to the zero level. That's where supply on one side and demand on the other are really close to each other. Now, at that level, the unemployment rate doesn't move much. It's not too volatile. It doesn't move much. And a move to 0.25 above or 0.25 below is normal. These statistical series have a life of their own. What really matters is really when the quantities go above or below 0.5% percentage points. So at this moment, it's hovering around zero, so it's perfect balance. And we've seen periods like these in the past, 2006, 2007, even 2017, 2019, and before that, also in the 1990s. Now, at some point, this balance is meant to move into one or the other direction. Now, given the level of restriction in monetary policy, the next tilting of this balance will be on the side of slowing and of supply being greater than demand. Now, we're trying to because obviously, in order to allocate capital, we always want to understand what is coming next and what kind of information we have got to discount. And the important information is, again, given by the labor market. So you see that we have spent very little time on inflation and a lot on the labor market, because that's where really the action will be in the next few weeks and the next few months. The chart on the left is showing us that it's a different way of showing the equilibrium in the labor market. The supply has been growing at about 1.5% of the last 3 years on average. Recently, the supply has been growing at slightly more, and the participation rate has been rising. So supply has been growing around 2%, 1.75 to 2%. On the other hand, demand for labor has been growing also, but much more. 3, 4, in excess of 4%, 3%, and is now slowly declining towards 1.75. And in fact, both demand and supply are matching. Now, we know that if we take, for example, if we take the supply as a constant, we are trying to figure out where the demand will start to put pressure on the unemployment rate to rise. So at this moment in time, at about slightly below 200,000 payrolls on a monthly basis, both series are in both demand and supply are in balance. It will take so about 0.5% of difference between the supply and the demand to create this visible change in the dynamic of the labor market. So 0.5% of difference between supply and demand is about 870,000 jobs. And if you spread those over a period of time, let's say a year, it's in non-farm payroll parlance, it would be equal to about a step down in monthly payrolls of about 70,000 every month. Now, the last prints in payroll was around 190-ish, which in fact puts the so between 190 and 200,000, which puts in fact the threshold at about 130. So every first Friday of the month, if payrolls is between 130 and 200,000, it's Goldilocks, it's soft landing. If payrolls start to move below 130,000 monthly, then we're getting closer and closer towards the market scenario, which has been, in fact, front run too aggressively. We could say, in fact, that the market is playing the sub 130,000 K of payrolls now, whilst you know, the evidence on a monthly basis is that payrolls are, and that's the chart on the right, are averaging at about 199, between 180 and 190 payrolls. So here you see the disconnect. We want to take the information from the market because it's valuable, but we also want to match it with the reality, because sometimes the market in the short run can really have aspirations that are slightly disconnected from the reality. And here we start to see that it's about it's starting to be disconnected from reality. So each payrolls that is above 130, in between 130 and 200, is pushing the expectations for rate cuts one meeting back out. So that is the reason why, in fact, the March meeting, the expectations for a rate cut at the March meeting are at this point in time fairly can be in fact qualified as very aggressive. There is no other way putting it, unless come early January or early February, a very, very negative or a big downside surprise in payrolls shows up in the data, and March is back on. But we've got to be careful with that. The slowing, the landing of the labor market, as we see on the chart on the right, on the left, is very gradual and is not showing a discontinuity yet. Okay, and in fact, jobless claims have not detected at this point. Yes, continuing claims have detected it. The duration of unemployment in the cohorts of 15 weeks and above and 27 weeks and above are starting to move in that direction, but that is not in itself strong enough a signal to support really the aggressive pricing that has been put in the market for the March meeting. So there is a scenario, and that this matrix is coming from the previous webinar, just to highlight that on on these tables, we see expectations for these markets or these statistical series 3 months after ImagineAlpha's unemployment rate rule has been triggered. 3 months. And in November, it was the first month. So we have until February really to, to observe whether the historical precedence is repeating itself this time around. So we will have to see, and that's why going back to the left chart here, to the left-hand chart, we see that the dynamic of the slowing of the labor market on the one hand, of the demand on the one hand, and the still fairly high supply of labor in the market is not conducive to a rapid collapse of that market. So we urge for caution. Now, it doesn't mean, and I will end that macro section of the webinar on this note. It doesn't mean that things underneath are not at work, and they are, because the financial conditions are restrictive enough. We think that neutral is at 2.5, but for reasons that we have been discussing before, especially reasons related to the budget policy, the economy is sustaining a higher level of equilibrium on a transitory basis. Okay, so volatility will return. Now we have our macro timing gauge, which has been given to us by the Fed, which is 4.1 unemployment rate. That's fantastic. Now we are looking at the markets for market timing and signals from the market as to a change in regime. Now, we have a lot of material. You can go to the website. We have, and you can ask Francois or myself directly. We have a lot of market timing tools. One that I want to start this section with is the timing of the volatility cycle, and that is the chart on the left. Even though we are in this lull, which is a sort of Goldilocks lull at this moment, we have to keep in mind the bigger picture, and the bigger picture is telling us that with a lag, the tightening of monetary conditions are conducive to higher volatility of financial assets. And that is the story of 2024, maybe the end of 2024, but at some point in 2024, towards the end, we don't know yet, but or maybe early 2025, volatility will be much higher than it is now. And if really something has surprised many participants in the markets, and us included, is how low the volatility has gone. It's gone even, the VIX has been declining all the way even below 12, which is in fact implying on a daily basis movements on the S&P of 0.75% on a daily basis for a year, which is annualized, so which is not rewarding for the risks that such a policy mix are creating. So we have a policy mix fiscally and on monetary conditions that is fairly risky. We are very close to discontinuity levels on some macro indicators, and we have a risk that is extremely underpriced. It's an opportunity. So the markets, in the market section, we want to focus on our models. What our models are telling us is that yes, early November, late December, late October, early November, around the FOMC meeting of the 1st and the payrolls of the 3rd, when our unemployment rate rule was triggered, something took place, a trend reversal took place. So SOFR deck 24 on the left and SOFR March 24 on the right, a bit later on, entered into uptrends, which is normal. It's it's just completely understandable. But you can see that for the deck contract, the accelerations are really sharp, and that's what our models intend to capture. A change in the trend, and then capture the accelerations in the trend. Now, last week, the acceleration around the FOMC press conference peaked, and it is fair to expect now a consolidation closer to 95.80. So giving back maybe 15 to 20 basis points from the peak would be welcome, especially if the Fed speak in the next few weeks comes in that direction to lower the probabilities of a March move. In any case, the final judge will be core PC on the one hand, but most importantly, we think the behavior of the labor market, and the next big number will be the December payroll early January. So the trend is, in the near term, between now and the next FOMC meeting at the end of January, it's fair to say that we will have a pullback in SOFR deck 24 towards below 96. So taking back a quarter point and more of cuts that were in the price last week, but staying above 95.80, because breaking below 95.80 would mean that, in fact, the labor market is much more solid than expected, hence the importance of the 4.1% rule. In terms of what the market is pricing in terms of rate cuts between March 24 and March 25, that's the chart on the left. Our model turned negative, for more aggressive cuts at the beginning of November, on November 1st, which was the FOMC then. It turned in downtrend that day. It has accelerated from about 95 basis points cuts all the way down to 155 last week. Here again, probably that the target will the target at about 165 basis points of cut, or 170 basis points of cut, will be hard to achieve in the near term, unless really something happens, either an external shock or a really bad print on the labor front in early January, and that, in fact, some unwinding of these aggressive rate cuts will take place first, just as a matter of the quantitative technical nature of accelerations and corrections in the marketplace. And you can see that our models really capture those these alternations in the trend. So we endeavor to find a trend, a bias, and then we endeavor to capture the accelerations and the sequence of accelerations and corrections. So on the left-hand side, 155 basis points of cut for the 12 months from March is probably a little bit too aggressive. We'll probably need to take one out, unless really the labor market shows that it's crumbling in December, which is which is not really what the jobless claims are telling us. And on the other side, on the right-hand side, is what is priced for 2025. And here, the interesting thing, the interesting signal from the market is that you will see that the spread is in uptrend, which means that, in fact, the market thinks that in 2025, there will be less cuts needed than it thought it would be required just a few weeks ago. Now, it's interesting because, of course, it goes with the front loading of the accommodation from the Fed. So a much more aggressive, assertive Fed in 2024 and a less aggressive and assertive Fed in 2025. The job will be done by 2025. Now, what happens if the market has it wrong, just like at the beginning of 2023, when the market was seeing a recession during the year and spent most of the year rolling back that forecast? Well, that's precisely what the models are telling us. There will be a complete reversal of these expectations, where too much has been front run on 2024 and too little in 2025. So there will be a reversal of both signals, but we are not there yet. We are not calling for that yet. We are happy to just call for, at this point, a pullback into a downtrend. We stay with a signal that rate cuts are coming in 2024, but not as fast as predicted, and that is because of the macro timing leg of our research. Now, going onto the bond market, we have discussed a lot about historical precedents. One that is fresh in our minds is the 2019 pivot at the end of 2018, early 2019. Now, there was no pivot from the fundamental side, from the macro side, because the unemployment rate didn't really move. It was just a pure financial stability pivot at the time, until later on in the year, or early 2020, when it became the external shock of the COVID black swan. But the early months of the 2019 pivot was a financial stability pivot that took, in fact, that had characteristics of yields moving down as they should, and the current move is fairly similar. We have the beginnings of a big pivot. So the trend that we've seen in November is really the front running of that pivot. We have not yet the macro signal. Now, it is important because you could argue that current situation is very different from 2019. There is no financial stability really since the spring, because of the financing facility that has been put in place by the Fed after SVB. So there is no financial stability issue really or stress of sorts. It could be the case that in the spring things start to deteriorate. We will have to see. But yet the market is moving with that theme. So the market really is saying something that the macro is not telling us yet. Okay, and the market is willing to take that forward-looking view that no matter what happens, we will see a convergence of bond yields all the way down to the neutral, which is between 2 and 2.5. It will take time, but that's the destination of travel. A top is in place according to the market, and although the chart on the right, our model is not telling us that a full top is in place in December. It is quite likely that the signal will come in January. It will be a surprise that if in January, if the 2-year yield, for example, doesn't rally back to doesn't go back up to 475 or higher, it is currently standing at around 444. The 2-year yield will be signaling a multi-month downshift all the way down to 2.5. And for the 10-year, the great loosening of the 10-year yield. Well, on the left, our model captured the reversal of the trend at the beginning of November, and then the snowballing effect of the CPI and the new and the last FOMC, with the accelerations from 430 all the way down to 390. And on the right, the monthly model, which is still in uptrend mode, but will likely also finalize its reversal in January. And unless really the 10-year yield were to move back above 420. 420 on the monthly, and you can see that it's also the reversal level on the daily model. So for the area of 420, 425 now for the 10-year becomes a pivot on the upside. So the soft landing scenario is characterized by long-term yields staying below 425, probably not accelerating too much for the time being, because the job market, the labor market is still in balance. It has not tilted to the oversupply yet. And the supply side is not being shocked enough by the financial conditions yet. That's what the data is telling us. But in anticipation of that, the yields cannot really rally much. And then there is the international situation. We have not talked about Europe or the UK, but even though the central banks there didn't talk about cutting rates, the macro guidance is more tilted towards the downside risks, especially in the euro area. The last IFO numbers this morning were confirming that, and the slowdown is gathering pace. So we would not be surprised that in the next few months, in fact, the spread, the yield spread will widen between the US and its European partners. We note that the 10-year bond at 2% has declined back to what neutral is in the euro area. It's interesting to note because the equivalent in the US is 2.5. So the US is 150 basis points behind where Europe is. It tells a lot about the relative perception of monetary policy and actually macro dynamism. So in the next 6 weeks, until the next set of central bank meetings, we will expect a bit less aggressiveness on the anticipations for the US, and probably a bit more on the European. And to end up now this webinar, it's important to note that all this sequence since November has been accompanied by a decline in the price of crude oil. The crude oil entered into a downtrend on the 3rd of November, exactly around the same time as the 10-year yield, for example, or the 2-year yield, or even the front end of the US curve. And that these days, Brent, the strip of Brent contracts for 2024 is trading around $77. Now, after having traded in the 73 area. Now, that move back up from 73 to 77 is considered a correction. But if really these contracts starts to trade north of $77 on a sustained basis, they will end up triggering a trend reversal. And that could be, in fact, the emerging signal that was needed for the bond market to start a correction. Because, of course, inflation expectations will start to move the other way. So there might have been a little bit too much, sugarcoating on the fixed income side, on the rates rally side, coming from the decline in crude oil during November and December, and that amplifier is starting to fade away and to reverse. So that is really the main thing that we will look at for a trigger of a correction, a bit more aggressive correction than the 15 basis points that we are seeing, 15 to 20 basis points that we are seeing in the weeks ahead. With that, Francois, I think that I'm done.
Carlos, thank you so much for all these insights and actions for the next quarter and your vision on the situation. Thank you so much. This video is going to be available very, very rapidly on our website, and you'll receive a link. But anyway, should you have any questions, comments, please feel free to contact Carlos directly or contact me to be the interface between you and Carlos. Thank you so much. Have a good day.